Hello everyone. In this recording we are going to discuss capital budgeting. This is chapter 21 and this chapter is all about understanding which projects, which investments we should make. Now when we talk about choosing investments or choosing projects, we're talking about which machine we should buy for the assembly room floor, which building we should buy for our operations. So we're talking about large capital assets. Hence, we are going to see in this chapter, we are talking about capital budgeting. Capital assets, whenever you hear an accountant talk about capital assets, they're basically talking about fixed assets. Okay, which large investment we should make in a fixed asset, in a capital asset for our particular future cash flow. So what you'll see in this chapter is capital budgeting. That's what we are discussing here. Capital budgeting is the process of making long-run planning decisions for investments in projects. Like I said, which piece of equipment, which machinery we should buy. All right, so when we are choosing our investments in a fixed assets, we are going to select among multiple projects. And each of these projects can span multiple years. Typically, we don't buy a piece of machinery or equipment or enter into a building for a one-year span. Now, because we are dealing with multiple periods, multiple years into the future, we are going to consider, in some of our decision making, we are going to consider what we call future revenues and future costs. Now, have you all heard of the situation that $1 today is worth more than $1 tomorrow? That is absolutely true. And the reason for that is because of this concept called inflation, right? You all know, you've heard the stories of your grandparents talking about, back in my day, I used to sit in the bleachers in Yankee Stadium for $2. Well, try to sit in the bleachers today at Yankee Stadium for $2. It's not going to happen. And that is because back then, when your grandparents are talking about that time, right, the dollar had a higher purchasing power, right? It had more purchasing power. It was able to buy more, okay? You could have bought a home in, let's say, 40 years ago, okay, in the late 70s, early 80s. All right, when you bought that home, let's say it was worth $40,000. Well, that same exact home today would be worth closer to $400,000. That is because the price has appreciated, and over time, additional to the price, the asset actually appreciating in value, that is because the purchasing power also of $1 is rapidly changing. The dollar back then was worth more. It had more purchasing power than it does now. That is because of the time value of money. Okay, so when we are entering into projects, we have to consider this. What we have to do is we have to get all of our dollars, both current revenue and costs and future revenue and costs, on the same playing field. And the way to do that is to convert all of our future revenues and future costs back to today's dollar values, also known as present value. So we are going to actually convert future revenue streams and future costs into current present value. We will see that here. Okay, so getting back to what we were talking about before we introduce this concept a little further with using some examples. When we analyze a project, we're going to analyze it both horizontally as well as vertically. So let's practice. Horizontally mean basically we're moving left to right. Okay, so when we are analyzing our project horizontally, that means we're actually analyzing the project in and of itself over the years. Year 1, year 2, year 3, year 4, year 5, and overall. Okay, that's the horizontal analysis of the project. A vertical analysis is actually analyzing project 1, 2, and 3, and 4 in year 1. project 1, 2, 3, and 4 in year 2. You're analyzing it up and down within the accounting period, all the projects. And you can see this slide here. If we go left to right, like as an example, project P, we're analyzing it 2016, 17, 18, 19, 20, 21, project O. So you're analyzing each project from left to right over the years, individual projects over the years, versus a vertical analysis. And we can see the year 2018 is kind of grayed out. So this is the analysis of 2018 for these 4 projects, project P, O, N, and M. Okay, so we can analyze by the year, looking at all the projects or individual projects over multiple years, horizontal versus vertical. So there are 2 ways to analyze our projects. Okay, once again, we've talked about this in the past, but we'll talk about it again here one more time. The stages in the budgeting process. When we are dealing with potential projects, potential assets to purchase, number 1, we need to identify the potential projects. Okay, identify the potential investments that we can make that agree with our strategy, what we're trying to do. Number 2, we're going to try to gather as much information as possible about these potential investments. And once we have all the information for all the potential investments, we can then start to forecast potential future cash flows. That would be both cash inflows and cash outflows. That's the prediction. And then, of course, based on predicting all the cash inflows and outflows, we will make our decision among the alternatives. Usually, I'm not saying always, but usually the investment that yields the greatest benefit, financially speaking, is going to be the one that is going to be chosen among the alternatives. And then, of course, once we choose among the alternatives, we are going to implement the decision, which basically means buying the asset, getting it set up, starting the project. But it doesn't end there. We actually, once the project is actually starting to produce, we are then going to evaluate the performance of that investment by really comparing the budget to what's actually happening. The budgeted inflows and outflows versus the actual inflows and outflows. We've discussed in length already in previous lessons about budgeting and comparing budget versus actual, which is the variance analysis that we've talked about in previous chapters. Okay, so new projects. What are we going to consider for analysis purposes when we're dealing with buying a large investment, a large capital asset? Well, new projects often require investments in current assets. So if we have a project coming up, we might have to buy more inventories, more receivables. These are, and of course, we might have to enter into more liabilities because we're buying these inventories and receivables. That is called working capital. You may have heard this term from other accounting classes, but the term working capital simply means current assets less current liabilities. So any additional working capital that's necessary to enter into if we choose a particular investment, that will indeed be considered. All right, we need to consider the differences among the alternatives of the investments that we could potentially buy, the differences in the working capital needs. So certainly that is going to be considered. Here are the 4 here are the 4 analysis methods that we are going to take a look at. The first 2 are very important because they consider present value, meaning basically taking all of our future revenue streams and our future costs and bringing them back down to what their value is at the present time. Basically putting everything on the same playing field. That would be the net present value method and something called the internal rate of return, IRR method. And then we have the payback period and we have the accrual accounting rate of return. Methods 3 and 4 do not consider bringing all the costs back to present value. So they're more, let me call them down and dirty type of analyses, very quick analysis. It's not getting into much detail. But the first 2 do consider bringing everything back down to present value. Therefore, methods 1 and 2, whenever we consider bringing everything down to present value, They are called discounted cash flow methods. All right, this is going to be very important. If you move on in accounting and you decide to specialize in being a valuation expert and you start to value businesses, you will be using discounted cash flow methods in some of your analysis. So this is kind of maybe the introductory step to those future studies for those of you that are going that way. Okay, so discounted cash flow measures, once again, they measure all expected future inflows and outflows, cash inflows and cash outflows, discounted back to the present point in time. What we are doing is we're converting the future dollars into present value dollars. It's because of the time value of money. Once again, a dollar received today is worth more than a dollar received in the future. That is because of, number one, inflation, and of course, the dollar received today could be invested. And because it's invested and it's growing over the years. Okay. All right, so the time value of money, that is the opportunity cost, and that is a key point. We talked about opportunity costs in the past studies. The opportunity cost is basically the benefit given up by choosing one alternative over another. So the time value of money is the opportunity cost from not having money today. Think about your own personal situation. If you are in that stage in life where you are literally living paycheck to paycheck and you are just getting by, you are just putting enough food in your mouth, you are paying just enough rent, you are earning just enough to pay that electricity bill, just enough money to put gas in your car without anything left over. Your opportunity cost is you have no excess cash to invest. And that is your opportunity cost. You are not having money today to take advantage of that time value of money. Investing so it'll grow over time. Now, as your career, if you're in that stage of life, it's okay. We're not always in that stage of life, right? Hopefully we grow from that and we are at school. We are working towards getting our accounting degree. And hopefully there are greener pastures ahead, financially speaking, and maybe one day you will have excess cash and you will be able to invest it. Maybe that comes in the form of entering your future employer's 401k plan, and you're just setting money aside, and you're trying to set as much money aside as possible. That money will grow over time. All right, so discounted cash flow methods certainly consider the time value of money. And we will restate the future cash inflows and outflows to present value terms. These discounted cash flow methods use what's known as the required rate of return. The required rate of return is known as the current interest rate, the current discount rate, hurdle rate, cost of capital, opportunity cost of capital. It comes with many different terms. But basically, the required rate of return is what we would earn on our investment in the future should we invest somewhere else. Okay, and that is typically considered the going interest rate in the current market. All right, so required rate of return is important when we are considering bringing everything back down to present value. So the net present value will certainly calculate expected monetary gains and losses from a project by discounting all future inflows and outflows back to present value. Only projects with, at a minimum, zero or a positive net present value are acceptable. Okay, so basically what we're going to do with net present value, and I know this is hard to read, but if you take a look at this Excel spreadsheet here, we have an initial investment, all right, of let me see, what is that? 648. The initial investment here, it's hard to read, but this is $648,900. And if we invest $648,900 today, we know that our annual cash inflows, and they're listed here, $166,680. I'm sorry, $648,900 we invest today. But say over time, in year 1, year 2, year 3, year 4, and year 5, I'm expected to get net cash inflows of $180,000 a year. Well, you can't compare $180,000 received at the end of year 1 and year 2 and year 3 and year 4 and year 5. Add 180,000, multiply by 5, and subtract it from 648,900. That would be wrong, because 180,000 received at the end of year 1 is not the same as receiving it today. Also at the end of year 2, year 3, year 4, year 5. These future cash inflows have to be converted to present value terms. And so what we are going to do is we are going to take a look. We're going to use a present value table, present value of $1. So what you're going to do is you are going to get the help of the present value tables, which we will see on in your textbook, page 932. This is in the appendix to the textbook. So we know right now that this is a $648,900 investment. The useful life is 5 years. You can see I'm circling up here in column D. The annual cash inflow is $180,000 a year, but the required rate of return here is 8%. So what we're going to do is we are going to convert these future cash flows into present value. So as an example, the net initial investment was $648,900. That needs to be made today. So they are already in. This $648,900 is already in present value dollars because it is a cash outflow. That's why you see this number in brackets. It's a cash outflow today. Now $180,000 received in cash inflow at the end of year 1. If I look at my present value table, what you're going to see is along the top along the top columns, you're going to see the different percentage rates. So we're going to work our way across to 8% column because that is the required rate of return here, the going interest rate, if you will. So if I look at my table on page 932, which is the present value of $1, and I look at the 8% column, and I look under period 1 along the left-hand margin, you're going to see different rows for the periods. So at the end of period 1, 8% column, I see 0.926. That's what this is here, 0.926. If I multiply the 180,000 times the 0.926, I'm going to get 166,680 at the end of year 2. So I'll go to 8% column, but I'll go to period 2. And it is 0.857 is the factor. That gives you 154,260. At the end of year 3, you get my point? You'll take the factor from 8%, period 3, is this 0.794. You work your way all the way down to year 5, 180,000. What this is saying is as follows. $180,000 received 5 years from now in an interest rate environment of 8% is the same as receiving $122,580 today. Okay? What we are doing is we are converting future dollars into present value terms. So the best way to approach this is to, like I said, even though the initial outlay is negative $648,900, converting the future cash inflows to present value, the net present value of this project is $69,840. It is positive. Once again, as long as the net present value is 0 or positive, financially speaking, you would accept. Now, this is an interesting case. I wanted to show you this because all the future cash inflows are exactly the same. There is actually a shortcut method to use here. And when you are receiving the same cash inflow or outflow, that's exactly the same year in and year out at the same time. In this case, it's the same time, once a year. You can use what's known as the present value of an annuity table. For those of you that have heard this term before, annuity, you know that it means an annuity is basically you are receiving or paying the same amount of money every year, the same exact amount and the same exact time every single year. And because it's exactly the same, there is a separate table, and this is on page 933. If you look at page 933, I'm sorry. I am sorry. I accidentally said table 3. I'm wrong. This is table 4. If you go to table 4, which is on page 934 in the textbook, you will see that the name of the table is the present value of an annuity. And so once again, we're going to go to the 8% column, but we're going to work down to period 5 because there are 5 periods of future cash inflows. And if we look at the factor in the table, 8% column, row 5, we get 3.993. So if I add up $180,000, all right, times 5, and take that amount and multiply it by 3.993, this is what you're going to get, $718,740. And the net is exactly the same, $69,840 positive. So that tells me this is a project, financially speaking, that we would accept. This is one of the best methods to use because you are bringing everything back down to the same playing field. What are these dollars worth today? You are converting future cash flows into present value, basically using today's current interest rate, aka the required rate of return. Okay, the internal rate of return method, which is the second method, basically calculates the discount rate at which the present value of all future cash inflows and outflows are equal. So basically, the internal rate of return is when the interest rate, the discount rate, is when that present value is 0. We will accept a project when the internal rate of return equals or exceeds the required rate of return. So if our required rate of return is 8% and the internal rate of return is, say, 9%, we would accept it. So once again, the internal rate of return method is basically when net present value is 0. So here we have another example where we know our initial investment is $648,900. That investment needs to be made today, so it's at period 0. There is no converting to present value. And basically, with the internal rate of return, in order to get the net present value to 0, you basically just got to play with the tables a little bit. And when we were playing with the tables, we came across the annual discount rate of 12%. All right, and when we basically convert our future cash inflows with the 12% column, period 1, 2, 3, 4, 5, here are the factors, you could see the net present value is 0. So we know, we have just proven through trial and error that the net present value is 0. The trial and error is to try to get the net present value to as 0, basically, as close as we possibly can get to 0. Once we do that, we said, okay, we have the internal rate of return. And once again, as we said a couple of slides ago, a project is accepted if the internal rate of return, in this case, it was 12%, if the 12% equals or exceeds the required rate of return. If the required rate of return is 10%, as an example, this would be a go. Net present value is generally preferred. All right, it just basically, it's a very simple concept. Let's take all of our future cash flows, convert them to present value based on the current market rate. It's very simple. It's very simplistic in that way. The net present value measures captures the value in today's dollars of the surplus of the project. Very straightforward, very simplistic. And it's just usually the best method to choose. Okay, and let me see. Now, you all know that life is interesting sometimes, and life doesn't always go according to plan. We all know that. We might be accepting one set of future cash inflows and outflows. Think about this in your own personal life. You're budgeting, and then all of a sudden, out of the blue, boom, you get this medical bill that you weren't expecting at all. You get this big car mechanic bill. You didn't think your car was going to break down, and all of a sudden, boom, you have to pay your mechanic $1,000. Things happen. We all know it. We've all experienced it. If you haven't experienced it, you're living in a bubble, or someone's taking care of the bills for you, but it's going to happen. And when it does happen, and you know what, sometimes it's the opposite way, where you get a cash inflow that was unexpected. You might win the lottery, or you might get an inheritance, or you might get a raise, or you might get a bonus that was completely unexpected. And now all of a sudden you have an extra $5,000 or $10,000 or $1 million or whatever. All right. So certainly sensitivity analysis is something that would be considered as well in regard to or as an expansion of what we just did by working with, say, the net present value analysis, where we were using expected cash flows. There are some uncertainties that are likely out there. And basically, sensitivity analysis is the what-if technique. Well, what if the required rate of return changes? Or what if the future cash inflows and outflows change? And that's something that we would want to consider as well. And now the methods that aren't as acceptable mainstream because they ignore the time value of money. One is called the payback method. Basically, the payback method is pretty simple when there is uniform cash flows in the future. And the example I just looked at had uniform cash flows where it was $180,000 a year for 5 years. That's what I mean by uniform. I mean, it's the same. So the formula for the payback method would be the net initial investment. And the example we were using, that was $648,900 divided by the increase in future cash flows. And the example we were working with was $180,000 a year. That will tell you how long it takes for you to recoup your investment. Once again, it ignores the time value of money. Now, if the future cash flows are non-uniform, basically what you're going to have to do is take the net initial investment and then subtract out the future cash flows year by year by year. And you have to count the number of periods or half periods or quarter periods that it's going to take to recoup your initial investment. You can't use a very straightforward division formula. And then last but not least, the accrual accounting rate of return. And once again, you are starting to learn as accounting majors this concept of accrual accounting. And basically what it does is it takes the accrual accounting net income to measure the investment. Here is the formula. You will take your numerator is your increase in the expected average annual after-tax operating income on an accrual basis. So basically what your net operating income is after taxes. On an accrual basis, that's your numerator. Your denominator is your net investment. All right, and so once again, the accrual accounting rate of return, it ignores the time value of money. And once again, because these last two options ignore the time value of money, I call them down and dirty methods. You can use them if you're trying to weed out like 100 investments and you want to weed it down to the top 10. Well, you can use a payback method or the accrual accounting rate of return method. But then once you get to the final 5 or the final 10 or what have you, basically your final potential investments, that's when I would suggest you use a method like the net present value method, where you're converting everything back to present value terms. Okay, so what are we analyzing? When we analyze a potential investment, there are 3 categories of cash flows that are really, really important. Number 1, of course, the net initial investment. That can include the fixed asset we are buying, or the increase in the working capital that we need to enter into, as we talked about earlier. And then, of course, in the future, the cash inflows from the operations, the net inflows, right? That would be the cash inflows minus the cash outflows in the future. And then, of course, at the end of the project, we may be able to sell our fixed asset or release working capital. And if that is correct, we're going to have a cash inflow at the end. All right, and so basically that's the after-tax cash inflow from the terminal disposal of the fixed asset, the investment, and the recovery of any working capital that we needed to tie up earlier in the project. So we're going to take a look at, of course, all three categories of cash flows when we are analyzing a project. After tax is a term that I used on the prior slide for the first time, and I just want to show you taxes certainly take a key factor in here, because taxes result in a cash outflow, and it's very, very important that we can't lose sight of our future taxes. So as an example, in this project, if we are going to invest and the project is going to generate us an additional $220,000 in future cash inflows, that's great. But guess what? In the future, we have to pay additional depreciation on the investment, the equipment that we bought. If the additional depreciation on the investment equipment that we bought is $120,000, our increase in net income is not $220,000, but on an accrual basis, it's going to be the $220,000 less $120,000 or $100,000. If the tax rate is 40%, what would be my taxes on $100,000? It would be $40,000. The increase in the net income is $60,000, but what about cash flow wise? Do we make a payment for the $120,000 depreciation? No, we don't. We considered that up front when we bought the equipment as a cash outflow, the initial investment. So the future cash inflow is going to be not the $220,000, but the $220,000 less the additional $40,000 tax bill. $220,000 minus $40,000 is $180,000. Or you can analyze it this way down here if this is more comfortable for you, which is part B. Once again, $220,000 additional cash flow, 40% taxes, that would be $88,000 in taxes. That gives you after-tax cash flow of $132,000. But the $120,000 extra depreciation times 40%, that would give us another $48,000 in tax savings, because of basically we're saying is the $48,000 is included in the $88,000. So $132,000 plus $48,000, the cash flow from operations is $180,000. However you look at it, the fact of the matter is we're not going to just concentrate on the additional cash flows of $220,000, because that is before tax. We want to take a look at it. What is the after-tax effect of this? It would be $220,000 less $40,000 or $180,000. All right, so make sure you are concentrating when you're doing project analysis. You are looking at after-tax cash flows, not before-tax cash flows. Tax is part of life. All right, we have to pay taxes. You all have heard the saying, and if you haven't, I will say it here. There are only two things that are certain in life: death and taxes. That is a saying that has lived on in accountants' world for a long, long time. And that is true. Death is certain in life, everyone's life, and so are taxes. Okay, so once again, the initial investment to buy the machinery and equipment, the initial working capital, right? Anything we need to get tied up in receivables and inventory. And then, of course, the after-tax cash flow from not only operating the investment, and then, of course, the disposal of the equipment at the end. All right, but the initial cash inflows, buying the machine, entering into working capital, and if we have any old machine, we can sell it today. So the after-tax cash flow of basically selling the old machine. Those would be the initial cash inflows and outflows. And then cash flows from operations, as I said, and I just went through an example with you, we have to consider the after-tax cash flow from operations. all right? And of course, savings from annual depreciation deductions, as we talked about. All right, and then the terminal, this would be the last part, actually selling the investment at the end. Anything we can get from disposing the asset at the end, after tax, of course. And of course, any recovery of recouping or recovering the working capital. And so that is certainly something that is extremely important. Once we've made a decision on which investment to buy based on this analysis, we have to continue, implement, of course, the decision, and the final step, of course, is managing the project and comparing actual results to what we budgeted. And so, of course, we want future audits on the project to make sure that it's all going well. If the actual results are less than expected, we have to figure out why. We need to come up with an explanation for it, so we can make changes in the future. And so these post-investment audits are certainly very, very important as part of the budgeting and the budget analysis in the future. Managers are going to be basically evaluated on how well the project goes on a project-by-project basis. So it's very, very, very important.